Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hammond here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're tackling a topic that's been making waves in the real estate world: the potential impact of an interest rate cut by the Bank of Canada. While some might see this as a welcome relief for mortgage holders, it's not necessarily the magic fix for the housing market that some might hope for.
That's right, Sandy. John McFarlane recently reported on this very issue, pointing out that while a rate cut could lower monthly mortgage payments, it doesn't address the underlying affordability issues in the housing market. The real challenge remains the high cost of homes, particularly in major urban centers.
Exactly, Steve. Even if mortgage payments become more manageable, the larger problem is that many potential buyers are still priced out of the market. The dream of home ownership is slipping further away for a lot of Canadians, especially first-time buyers.
And let's not forget, Sandy, that a rate cut could also have unintended consequences. For instance, it might fuel further demand in an already tight market, pushing prices even higher. It's a complex situation, and it's important to look at the bigger picture beyond just the immediate benefits of lower rates.
That's a great point, Steve. It's about balancing short-term relief with long-term stability. The Bank of Canada has to tread carefully here. An interest rate cut is a tool, but not a silver bullet for solving the housing crisis.
And as McFarlane highlights, the real solution lies in increasing housing supply and improving affordability through policy measures. It's about creating a sustainable market where more Canadians can achieve their dream of homeownership without being stretched too thin financially.
Absolutely, Steve. It's a multifaceted issue that requires a comprehensive approach. Hopefully, with more awareness and informed discussions, we can move towards solutions that benefit everyone in the long run.
So, Sandy, it seems like the Toronto housing market is going through some significant changes. Prices are dropping, which is causing quite a stir among investors and landlords. But for first-time buyers, it looks like there might finally be a silver lining.
That's right, Steve. Fergal McAlinden reported that while the price slump is tough for some, it's opening doors for others who were previously frozen out of the market. Detached home prices in the Greater Toronto Area have fallen by 7.5% year over year, and that's making a real difference for people on the margins.
Leah Zlatkin, from Mortgage Outlet, shared some interesting insights. She mentioned that many first-time home buyers who have been waiting for years are now able to buy homes. Townhomes and row homes, especially those in the center of rows, are priced within reach for many.
Absolutely, and it's not just within Toronto. Smaller markets outside the city, like Tottenham and North Aurora, are offering great opportunities too. Buyers can find homes around the $750,000 mark and still commute to the city via the GO train.
And let's not forget about the bidding wars, Sandy. Those intense competitions that drove prices up during the pandemic are now a thing of the past. This shift is giving buyers more room to negotiate and secure better deals.
Right, Steve. It's a refreshing change for those who've been saving up and waiting for the right moment. With prices cooling and the possibility of interest rates dropping, it seems like a good time for those first-time buyers to jump in.
However, it's important to note, as Chris Allard from Smart Debt Mortgages pointed out, that core living in Toronto is still out of reach for many workers earning between $70,000 and $140,000 annually. There's still a long way to go in terms of overall affordability.
That's a critical point, Steve. While the current market provides opportunities, it's not a complete fix. The affordability issue remains, especially for those aiming to live in the city center. But with the Bank of Canada potentially cutting rates soon, there could be further positive developments.
And Leah Zlatkin also mentioned that bond yields are down, which could lead to lower fixed rates in the near future. We're in a bit of a holding pattern right now, but it's a hopeful scenario for new buyers looking to enter the market.
Indeed, Steve. It's a dynamic situation with a lot of moving parts, but hopefully, these changes will continue to benefit those looking to make their first home purchase. The key is staying informed and ready to act when the right opportunity presents itself. The Canadian Real Estate Association has reported a significant milestone for August home sales, marking the highest number of transactions in 4 years. The association noted that 40,257 homes were sold across Canada last month, which is a 1.9% increase compared to August of the previous year.
That's quite impressive, Sandy. What's also interesting is that this marks a 1.1% increase on a month-over-month basis, continuing a streak of 5 consecutive months of rising home sales. Since March, transactions have cumulatively risen by 12.5%.
Yes, Steve. And while the Greater Toronto Area typically leads these gains this time around, sales in Toronto were slightly down compared to the previous month. However, this was counterbalanced by increased sales in other major markets like Montreal, Greater Vancouver, and Ottawa.
Sean Cathcart, the senior economist at CREA, mentioned that the trend in rising activity could potentially accelerate this fall. He attributes this to the seasonal surge in new property listings, which usually occurs at the beginning of September.
That makes sense, Steve. Cathcart also pointed out that if last year is any indication, we could see sales pick up even more in the coming months, especially if the Bank of Canada decides to cut interest rates this September.
Indeed, the central bank's decision is highly anticipated. Financial markets are expecting a quarter-point rate cut to 2.5%, which would end a series of 3 consecutive rate holds.
Matt Hansberger from Royal LePage Atlantic shared some insights on the maritime housing market, describing it as more of a kiddie coaster compared to Toronto's roller coaster market. The region has seen less dramatic fluctuations, despite the earlier downturn caused by tariff-related uncertainties.
Hansberger mentioned that the Atlantic region was affected by tariffs, causing uncertainty that dampened the spring market. However, he expressed optimism about being slightly ahead in trades compared to last year, hoping for continued momentum as geopolitical conditions stabilize.
The Canadian Real Estate Association also reported a rise in new listings, which were up 2.6% month over month in August. There were 195,453 properties listed for sale at the end of the month, reflecting an 8.8% increase from the previous year.
It's important to highlight that the national average sale price of a home in August was $664,078, which is 1.8% higher than a year ago. However, the Home Price Index, which aims to represent typical home sales, saw a slight decrease of 0.1% between July and August.
TD economist Rishi Sandhi provided some insights, noting that while demand is improving, supply and demand conditions remain relatively tight across several provinces. He noted that in British Columbia and Ontario, market balances tend to favor buyers, yet average home prices have been lifted by the performance of more expensive housing segments.
Sandhi expects this trend to continue in the coming months, suggesting that while there are opportunities for buyers, sellers need to price their properties appropriately. Hansberger echoed this sentiment, advising sellers to avoid overpricing, as buyers are willing to wait for reasonable deals. The latest data from the Canadian Bankers Association is showing a concerning trend. Mortgage arrears at Canada's Big Six banks are rising faster than the national average. 5 out of the 6 banks are now exceeding this average, which is unusual given their typically low delinquency rates. This surge could be an early sign of deeper financial stress across the country.
That's right, Steve. Historically, these major banks have been known for their risk-averse strategies, so seeing them with higher arrears than the national average is definitely a red flag. It suggests that even the most stable financial institutions are feeling the pressure right now.
It's an indication that the economic challenges are not just isolated to individual borrowers, but are affecting the broader financial system. This could have implications for the housing market if the situation continues to worsen.
Absolutely, Steve. And it's not just the financial sector that's under strain. Toronto's unemployment figures are painting a worrying picture as well. In August, the number of unemployed people in Toronto hit 392,300, marking an increase of 11.1% year over year. This accounts for over 1 in 5 of Canada's unemployed, which is quite significant.
That's a substantial number, Sandy, and it indicates that the job market recovery for Toronto might be further off than anticipated. The Toronto Census Metropolitan Area now includes cities with some of the highest unemployment rates in the country. This could dampen the real estate market recovery prospects for the region.
Right, and when you combine these unemployment figures with the rising mortgage arrears, it suggests that many households are struggling to keep up with their financial obligations. It's a multifaceted problem that could have long-term implications for the housing market and the broader economy.
Exactly, Sandy. And there's also a broader issue at play here with Canada's household debt. The recent improvements in the debt-to-income ratio were largely due to population growth rather than actual debt reduction. As population growth slows, this ratio is rising again, marking the third consecutive quarter of increase.
That's an important point, Steve. It's crucial to understand that these improvements were somewhat misleading. Now that the growth is slowing, the underlying debt burden is becoming more apparent, and that could exacerbate financial stress for many Canadian families.
And all of this is happening while Canadians reportedly feel less satisfied with life, according to recent data. Life satisfaction has dropped significantly since 2021, with Alberta scoring the lowest and Ontario not far behind. This decline in satisfaction can reflect broader economic and social pressures that are impacting individuals across the country.
It's a tough situation, Steve. As these economic pressures mount, it's crucial for policymakers to consider comprehensive strategies that address these intertwined issues: unemployment, mortgage arrears, and household debt, to stabilize the housing market and improve overall economic well-being. Steve, we've got a busy week ahead in terms of economic data from both the United States and Canada. On the U.S. side, we're looking at retail sales figures for August, which are always a key indicator of consumer spending and economic health.
That's right, Sandy. Retail sales in the U.S. can provide insights into economic momentum, especially as we approach the holiday season. A strong retail sales report could indicate consumer confidence and spending power, which are critical for economic growth.
Exactly, Steve. And over in Canada, we're anticipating some important housing figures. The Canadian Real Estate Association recently reported that home sales across Canada rose by 6.6% in July compared to the previous year. That's a significant increase.
It is indeed, Sandy. And on a month-over-month basis, home sales rose by 3.8% from June. This upward trend in housing transactions since March is certainly noteworthy, and it'll be interesting to see if August continues this momentum.
It will be, Steve. The housing market has been a focal point for many Canadians, especially with the ongoing discussions about interest rates and affordability. The Bank of Canada's decisions in the coming months will be crucial for maintaining this trend.
Absolutely, Sandy. The Bank of Canada held interest rates at 2.75% in July, and many are watching to see if there will be any changes this month. A rate cut could further stimulate the housing market, but as we've discussed, it's not a silver bullet for affordability issues.
True, Steve. Meanwhile, the 6-month trend in housing starts increased by 3.7% in July, according to the Canada Mortgage and Housing Corporation. This indicates a growing supply, which could help ease some of the pressure on the market.
That's a good point, Sandy. More supply can potentially stabilize prices and make housing more accessible. However, it's a complex issue with many moving parts, including economic conditions and policy measures.
Agreed, Steve. It's a dynamic situation, and as we keep an eye on these upcoming figures, it's crucial to stay informed and ready to adapt to changes in the market.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.k to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.